Okay, chapter 12, we want to investigate the concept, and really it is sort of a concept, I guess, of analyzing common stocks. In other words, how do you figure out what a common stock is actually worth? So, the security analysis itself is the process of gathering data and then using that to identify here what we're referring to as the value of a share of stock. We have a very simple formula for deciding to buy shares or not buy shares. Figure out what you want to pay. What's the most you'd be willing to pay for this stock? Let's say that the value you've determined, the most you'd be willing to pay is $50. The next step in is figure out what it costs to buy that stock. If it costs less to buy it, let's say it costs $45, since that's less than the $50 that you say it's worth, you'd be willing to purchase that stock. So that is essentially the process that we're talking about. The more technical terms then is we're trying to determine what the intrinsic value is. It's the underlying value of the stock. We need to find this, or you can try to attempt to find this, using something called fundamental analysis. And again, a prudent investor only buys a stock if the market price is less than or doesn't exceed what they think the stock is worth. So we need to understand the factors, the variables that we're going to estimate, that we're going to forecast and use in this analysis. So we're going to have to determine the future cash flows that we think are going to occur. What's the discount rate? The time value approach. How are we going to assess that and apply that? And of course, we need to understand something about the riskiness of the asset so that that can be adequately applied to the discount rate. So we're going to talk essentially what's referred to as the top-down approach. The top-down approach essentially I think is the most logical kind of approach to take. The first step is you need to understand something about the economy. So we're going to analyze the overall state of the economy and where we think that economy is going to go. The second step then is to look at the industries. What we're trying to do is identify industries that are going to perform exceptionally well or above average in this economy that we have now forecasted or developed a forecast for. We want to understand the characteristics of the industries. We need to understand the competitive nature within those industries. And finally, we want to look at the companies, do a fundamental analysis, looking at the financial condition, the historical behavior of the company's stock, but we want to try then to identify good companies inside the good industries given the economic analysis that we've started with. There's a theory called the efficient market hypothesis. And it's a rather simple theory, but it's a fairly complex rationale, I guess. I mean, stating the theory is very simple. The proving and the research that involved is rather complex. What is an efficient market? An efficient market is a marketplace that is so efficient that when information is provided to the public, that information is very quickly transformed into the current stock price. So if you believe in the efficient market, what you essentially believe is that securities are rarely substantially mispriced because information gets in there very, very quickly. The second thing here is that there's no security analysis then is capable of finding mispriced securities. So this concept of fundamental analysis at least looks a little suspect. Because that's what we're going to be looking at. We're going to be looking at the company and its information to try to decide what the value of a company actually should be worth. So let's continue on. Don't lose patience with this yet, because I think it's a fairly important process. We need to be assured that when information is provided to the public, that information finds its way into the stock price, and it does it in an efficient manner. It does it it affects the price in the right direction, up or down, and it also has some meaning as far as to the magnitude of that change. And we want this to happen very quickly. You don't want to have to wait a long time for these price changes to occur. So fundamental analysis is still going to be important. The reason it's important is there's all the people who are doing this fundamental analysis are the people who are making the market efficient. Since we need information, and we need information to affect prices, we have to have people using the information. Second, financial markets might not be perfectly efficient. If they're not, if prices don't move quickly, and if they don't move comparatively in the same magnitude, then we still might need to do some fundamental analysis to find some mispriced securities. And finally, that pricing errors are inevitable. I mean, in the end, we ultimately end up from time to time with stock market bubbles, and those bubbles burst. Well, how can that happen? How can a bubble happen? Essentially, information and the analysis of that information drives investors to a point where the prices don't really make any sense anymore. So at that point, some investors reevaluate, and then this bubble bursts. So that is the idea here, is that we still need fundamental analysis, but we do have to be careful and understand how prices do change in the marketplace. So let's first start talking a little bit about economic analysis. We wanted to have some understanding of where we think the economy is going to go. Now, this is not an economics class, right? So we're not going to get into the detail about how these things are all connected or what causes the necessary changes in these variables. We're going to look at the variables as data points and try to determine what the data points tell us. Stock prices are obviously influenced by the economy and economic events. I'm sure you understand, and I've heard in other classes instructors talking about a business cycle, that certain companies, certain industries follow the marketplace and follow this cycle. So there'll be ebbs and tides in the performance, the revenue of companies as the economy itself changes. So let's think about some variables. The key economic measures that we want to look at is gross domestic product and industrial production. Gross domestic product is the market value of all the goods and services produced in the country. We can find this fairly easy. You can go to it's the St. Louis Federal Reserve website, and you're going to look for something called Fred data. I'm sure Fred means something. I don't know what it means at this point, but Fred means it's a database, and you can identify and find the gross domestic product. Now, there's a whole bunch of different ways that they measure this, but these are all data points that identify the gross domestic product so that you could actually graph them yourself if you wanted. Now, of course, the Fed also provides graphs of this data, so you don't necessarily have to create the graph yourself. Industrial production as it states, measures the activity, the output from the industry. And again, as production goes, so goes the economy. So with rising GDP and with rising industrial production, that would imply that the economy is growing and is expanding. What other kinds of factors can affect the business cycle? Well, certainly the government's fiscal policy, how the government spends money. How are tax revenues gathered? How much taxes are available to be gathered? What kind of spending do they have? How do they manage debt? We obviously know that the government spends a lot of money. Taxes and the taxation system is a very big question in our economy right now. And of course, debt is totally out of control when it comes to the government. So, all of those things have an impact on the business cycle itself. Monetary policy. How does the Federal Reserve and the federal banking system, how do they manage the money supply? This has an impact on interest rates. And of course, as interest rates rise, businesses don't want to invest because they don't want to borrow because interest expense rises. So this can all have impact on the business cycle and the economy. What else could be there? Inflation, consumer spending. Consumer spending has a huge impact on the economy. If you're buying a lot more materials, for instance, when the economy is really good, people tend to buy a lot more luxury items. They spend more of the money that they're earning because they're earning more money. So all of these are factors that ultimately have an impact on the business cycle itself. So what are these things? There's something called an index of leading indicators. And again, these numbers are all readily available from this St. Louis Federal Reserve. We will look at and go out and look and try to gather some of this information in a research project later on. But this predicts the direction of the gross domestic product. Personal income. It tracks consumers' buying habits. Retail sales. Retail sales measure consumers' attitudes. Money supply, obviously, is the growth of the economy and inflation. Consumer prices and producer prices are measurements of inflation. We can look at employment, the unemployment rate. We can look at housing starts. Again, all of these things affect the economy or are measures of what's going on inside an economy and kind of give us a picture today of where the economy is. Now, of course, our job or the job of the economic analyst is to predict where these things are going, right? Really doesn't matter that we were in a recession last year. I want to know where we're going next year. Again, there are some other impacts here, some other things you can look at. I know the different variables that they talk about, but some things here that you may want to read a little bit more about. What happens if we have a weak dollar? Currently, we have a very strong dollar, but a weak dollar is the result of trade imbalances, right? It has a negative effect on the market. Well, we have a strong dollar, so you would think that it should have a positive effect on the market. But in general, right, these variables give us a picture, right, of where we think we are in the economy and where we will be moving. So what are some sources? Where can you find some information? Wall Street Journal, Barron's, most of these are publications on a monthly, weekly kind of basis, some of them obviously on a daily basis. How can we ultimately use this economic outlook? So whatever your analysis is, how do we want to use that information? We want to try to identify areas for additional research. What industries are going to benefit and what industries are going to be hurt in this economic outlook? I think it kind of makes sense. If if we assume a certain economy and companies are going to perform poorly, or excuse me, industries are going to perform poorly in that economy, an industry is defined by the companies within it. So if it's going to be a poorly performing industry, the companies in that industry are going to perform poorly. So we want to find companies that are going to benefit, and then we want to evaluate the companies within those, in quotes, good industries, or the industries that are going to do better given our analysis. Again, stock prices usually change before the forecasted changes become apparent to us. So, sometimes, we see stock prices will change, and what happens is it might take a month, 2 months, until there's actually some evidence that the market has changed. So there are lots of indicators, they talk about indicators, that show us pictures. And some of those pictures are predictive. They tell me changes are going to occur. But there are also some indicators that are, they're reporting. They tell us when the change has actually occurred. So, we predict something is going to happen, and then we have to wait and get some kind of a database that tells us that the change actually occurred. What about the industry analysis? Well, we have to evaluate the competitive position of the industry, right? We're looking for those companies or those industries that have growth opportunities, that have potential, right? We want to then, again, as I mentioned earlier, identify companies within that industry that are going to be moving forward. So what kinds of questions do we need to ask? What's the nature of the industry? Is the industry regulated? Is labor important? What about technology? How does technology fit into this game? Which economic forces are going to have the greatest impact on this company, on this industry? And then in the end, what are the financial and operating considerations? Is money readily available? Are there any changes in the operations within the industry? What's the access to capital? Is there something available that they can use to move forward that's going to help them grow? So again, all of those things are issues that affect an industry. Now there is a concept or a theory that's referred to as the growth cycle. And essentially it looks at industries and their lifespan, if you will. So when industries are very new, we say they're in initial development. They're very risky. The dropout rate of companies within the industry is tremendous. But there's obviously, with this great amount of risk, there's actually a lot of growth potential that could come from that. Once an industry has matured into this next stage, the rapid expansion space, things are going to kick on. Investors are going to start really looking at the industry. Consumers are really starting to get to understand the products and services. So we're going to see very fast growth at this time. But eventually, the industry is going to mature. Competition is going to be set up. The competition is going to smooth out some of this growth. It's going to be spread out amongst the companies within the industry. And eventually, the returns are going to become more profitable. So it's at that mature growth stage that it's easier to, or easiest to, identify companies that have the potential for continued growth. That's where we would like to focus. We would like to find industries in that mature growth area that will give us the most predictable outcome for our investment portfolios. And stability or decline, right? we know the demand for the product is now starting to diminish, right? There's not a big market anymore for buggy whips, right? That market has declined over time for obvious reasons. There's no longer stagecoaches. That industry has disappeared, right? So after a while, the demand for the product just disappears. Investors no longer need or desire the products and services, so ultimately they disappear. So where can you find information about industries? Well, you can go to some publication. Our library happens to have something called Standard & Poor's Industry Surveys. You can go to that reference book, and you can find an industry that you're interested in, and they will give you a synopsis of the industry. They'll talk about the variables above. They'll talk about the nature of the industry, the risks, the impact of labor. They'll talk about all of those things. So again, as a research assignment in the next week or so, we are going to go out and we're going to pick a company. You're going to be following a company. You already are. And once you look at that company's industry, you'll write a short little essay, if you will, about what you think about the industry that your company is in. So again, that's part one. This is a fairly lengthy chapter. So I'll see you again in part two.